Welcome to this month's Fixed Income Outlook. In August, we're talking about three important trends. The first is whether there's a Save Your Progress button in wealth creation. The second item that we're going to cover is whether optimization is worth it. And the third thing that we're looking at is how the budget has changed fixed income for investors. So firstly, let's start with saving your progress. My colleague Ram and I are going to be doing a webinar on this in more detail. So the idea is, imagine you're playing a video game and the levels are getting increasingly difficult. You would really like an option to pass a checkpoint and save your progress. This is what investors need to do in today's market context. However, what tends to happen is they're just going ahead into more advanced levels without actually stopping past a checkpoint and taking stock of what they have and preserving their progress. So fixed income allows us to do this, and this is what we're going to be spending a lot of time educating investors on this month. The second item was optimization and whether it's worth it. So what we've noticed amongst investors is that they keep trying to predict certain things and spend a lot of their energy in trying to get their forecasts right. But forecasts are wrong almost 50% of the time, and this means that that's not a very productive use of energy. The next trend that we've noticed is that even conservative investors have changed the way that they look at wealth creation by trying to optimize either returns or tax. And this has actually not worked out in their favor because the changes in the budget have actually opened up more opportunities for holistic multi-asset wealth creation. So what investors actually need to be doing in today's market context is try to optimize for risk rather than returns and tax efficiency. And moving on to the last thing, which is how the budget has actually changed your fixed income investments. Let's look at how the new tax rates work. If you have a listed bond, then long-term capital gains are now 12.5%, and the time frame to become long-term is 1 year. If you have an unlisted bond, this time frame is 2 years and it's the same capital gains tax rate. If you were a mutual fund investor in debt funds, then any investments that you made before March 31st and which you sold before the budget would have a long-term holding period of 3 years and would be taxed at 20% with indexation. If you made these investments prior to March 31st, 2023 and you are planning to sell them anytime in the future, that is after the budget, if the holding period crosses 2 years, then you pay 12.5% as long-term capital gains. If it's earlier than that, then it's slab rate. For any investments that were made after March 31st, 2023, there is no concept of long-term, which means that your slab rate will apply to investments regardless of when you buy and sell them. So these are the changes that happened in the budget. This is what we think investors should focus on, which is risk optimization and saving their progress. If you have any other recommendations for a safer way of investing, let us know in the comments below.